Perhaps I could ask each panelist to give us all a brief background of what they do, and then we can get started. Arvind?
Thank you, Sumit. My name is Arvind Rajan. I work at Prudential Financial, specifically in a division that we call PGIM, which is the Global Investment Management Division, and within that in the fixed income area. So what I do is basically oversee global emerging market and FX investments totaling about $60 billion. We are, give or take, about $700 billion in assets.
Hi, I'm Bob Savage. I'm the founder and CEO of CCTrack Solutions. It's a $3.9 billion FX overlay and FX-focused quantitative CTA. The CC stands for CITIC Capital, so I partnered with our Chinese friends. And before that, I spent most of my time on the sell side at small bank Goldman Sachs.
Very small. Cristian?
Yes, I'm Cristian Homescu. I'm from Bank of America Merrill Lynch, Chief Investment Office for the Global Wealth and Investment Management Division. The team is looking into all the quantitative approaches that are for that investment and wealth management division. And before that, I was lead quant for front office trading desk, commodity FX, and I was also interested.
Thank you. And just to round out the picture, my name is Sumit Roy. I'm a portfolio manager at Magnetar Capital. Magnetar is an alternatives asset manager with about 13 billion of assets under management. And I work in the fixed income part of the business, which manages about half of that. And most, if not all, of what we do is focused on private structured credit by and large. So the interesting thing to me, at least, is that we now have somebody from alternatives, long only, traditional hedge fund, CTA, and sort of a bank quantitative investment side. So let me just start by asking everybody to comment on what active versus passive management mean to you, and assuming fees to be equal, what would govern your choice of one versus the other? Arvind, you want to take?
Yeah, I'll be happy to start off. In everything I say today, I'm going to take a somewhat fixed income biased approach. So please keep that in mind when you're kind of thinking about what I'm saying. And specifically also, I'm talking about relatively liquid public fixed income. So that would also tend to, skew some of what I'm going to say. So to me, I think passive is a huge phenomenon in both equities and fixed income. Just this year, we've seen a huge percentage, 20 to 30% of flows going towards fixed income passive and equity passive mandates. I think that's true both on the institutional side and on the retail side. So it's certainly something that everyone in the industry needs to take very seriously, buy side, sell side, and it has, I think, significant implications going forward. Specifically from the fixed income side, I think that passive means something a little bit different than what it means on the equity side. I'll talk about that a bit later, but to me, I think that the very meaning of passive in fixed income is a little bit subject to question. One could say that it means one should simply mimic or exactly replicate a market cap based index or benchmark, which is the normal meaning that's assigned to the term. The underlying premise, which is that the market cap benchmark is a good one to mimic, which in the case of equities is supported by the CAPM model, is less obviously true for fixed income, given the Miller-Mordillian result that companies are essentially free to lever up with debt as much as they kind of want to in the context of the valuation. In other words, the enterprise valuation and the amount of debt they have don't bear a strong resemblance to each other necessarily. So using a market cap weighted index by itself is kind of something that needs to be justified. on its own. Empirical evidence seems to show that fixed income active managers are more successful than their equity counterparts. The median US core manager has, for example, outperformed their benchmarks. In the case of equities, that's not necessarily the case. And the last point is that passive is much harder to achieve in fixed income because actually, I think, with 20 times as many bonds as equities, most so-called passive managers don't actually come close to owning the market. So as a result, you get a ton of tracking error relative to what the benchmark achieves. So these are some of the things I immediately think of when I think about passive. That doesn't automatically make active a good thing. I think you need to, in every case, always only pay for what you're getting. And it's no less true for active than it is for any other type of investment.
Cristian?
So for me, it's more in terms of what is the strategy providing to the client. So to give an example of what I'm talking about, we have found out that most of our clients actually prefer to have a strategy which is defined in terms of their financial goals, and for them a strategy is successful if the probability of success to achieve those financial goals is above a certain threshold, which actually makes it much more straightforward for the clients to decide whether that strategy makes sense for them or not. And so it's also true that right now more and more passive strategies are getting into the market, and that includes to some extent the so-called smart beta strategies. And whether one is better than the other, for me it's more like I'm looking at the evidence, and I'm looking at how good is the strategy in not only in the history but also in all the relevant market regimes that we are going to have in the future.
Well, it's interesting. Different asset classes have different responses to what is passive and what is active. I agree completely with that point. Foreign exchange, because it doesn't have an index, is harder to say, well, what is passive and what is active. There isn't, the dollar index is kind of meaningless, and it's not that liquid. So chasing after an index in some markets doesn't make a lot of sense. But to your point about smart beta, which is a trigger word to CTA, there are different levels of what is active and what is passive, and it all comes down to a process. So 20 years ago, if we were in a room talking about what's alpha to a CTA, it's I have a better trend model than you do, so pay me 2 and 20. Today, getting paid 35 basis points with no ups, with no performance, is the normal price for a trend model. So there is a cyclicality to what is beta and what is alpha, what is passive and what is active, may well also fall into this because there's increasingly a number of ETFs that are being put together that are that replicate hedge fund decision making. I can come up with a basket of buying high dividend stocks. It's a process, generates a smart beta or an alpha. And how do you tell the difference? So to me, it's a more complicated question than the one that you seemingly sneaked into us. But where I find the interesting bits are about liquidity internal to this, which is the dispersion of equity indices is very interesting but fairly simple. The dispersion in a market cap fixed income ag is really complicated. You have multiple dimensions of term and that convexity that's implicit in that is not easy to model. So even the tracking error isn't a surprise, but there's alpha there in how you construct and track that, which is very different than, so there's a degree of difficulty, not to mention the inherent volatility of each of these markets. I think making alpha in a very low vol environment is sort of the tide going out and seeing who's wearing their swim trunks properly.
So I'll just add two comments to this and tie a bit of this together. In the hedge fund space, we found, at least in the hedge fund that I work in, a few years ago we were trying to benchmark our various strategies. So the idea is that we have a bunch of smart people doing what are, I guess, classic hedge fund strategies: merger arbitrage, convertible bond arbitrage, etc., etc. For some reason this is dying. Sorry.
Yeah.
Can you guys hear me?
Yes.
Okay. So we discovered that, and part of it was just to see how much value the particular portfolio manager in question was adding. So somebody would say, look, I've made X%, and you would mentally think to yourself, well, some portion of that X% is quote unquote the market, or the particular opportunity that you're looking to pursue, because almost everybody who's been part of this so-called active hedge fund world knows that by and large there is some risk premium that you're trying to capture in some way or format. So what we did was we tried to construct a portfolio, at least in our merger arbitrage business, an index, if you will, of all the merger arb situations that were happening. And very simply put, it was the classic thing of every time a merger gets announced, you blindly say that I'm going to go out and buy the stock that's being acquired, perhaps delta hedge it or not, as the case might be, but effectively you buy that entire set of opportunities. And then we discovered two things. The first thing was that actually provided some degree of excess returns, which was interesting enough. And then the sort of the differential stock picking, meaning which particular situations am I going to be outscaled in versus, or outsized in versus others, which ones am I going to disregard altogether, that ended up being a lot more uncertain. And the net result of all of that was that we then decided that we were going to create a bunch of what we called alternative risk premium strategies, which is kind of in line with what you were saying, which is to say that, look, let's just take all our collective intuition about any particular market. And all of us who've had whatever it is, X, 5, 10, 20, 30 years of experience, know that we like situations, whether it's on the debt or the equity side, where we like companies, or we have an inherent bias towards, in the case of, say, merger arbitrage, companies that are being acquired for strategic reasons as opposed to financial situations or reasons. We like companies beyond a certain, or merger situations that are of a certain size and above. And then we discovered that when we actually codified this intuition and created what were relatively simple filters or decision rules, we were able to then create a product that was, by and large, in our minds at least, captured perhaps, I'm going to make up a number here, 80% of the so-called alpha in that business with less than 80% of the cost. And then as a result, one of the major initiatives that our firm is taking is to see whether we can create alternative sources of alternative streams of this so-called hedge fund risk premium products, which are really the same things that 5 or 10 years ago we would have been beating our chests on and saying, look, we're very good at convert arb or distress or whatever it is. And that taught us a pretty interesting lesson, that in today's market, where intellectual property or intellectual intuition in some ways is being codified, it's very easy to execute. Really, a lot of the value that people like us provide ends up basically being figuring out ways to provide access to that intuition in a way that is low cost and still provides excess returns. So one of the other sort of things that came out of at least our discussion here is that active management or active seems to be a lot more dependent on two things: the asset class, and secondly is a form of investment, meaning that if you're trying to basically be an active manager when you're running a mutual fund versus a passive manager, it's very different than if you're doing it in the form of, or as a long-only asset manager versus doing it as a alternatives asset manager versus doing it as a, I'm not sure there is an equivalent, as a pure private equity or a private debt person. So I'm just wondering whether anybody has any intuition about...
I mean, I think the time horizon of holding period for an active versus a passive manager matters here. So and there's inherent in the structure of how we all get paid as alternative asset managers. We all, anyone that's in the CTA community lusts after the idea of private equity because you give me money for 10 years and I'll talk to you then. Thank you very much. It's not quite that simple, but there's a large degree of trust and opaque mark to market, and not very clear, views on where you are at any given point in time or liquidity for your investment. Whereas on the other side of the coin, a CTA offers daily liquidity, generally does a managed account, so my process is pretty transparent, and my fee structure is about how much do I trade and what's my bid-ask spread. That eats away at the potential. So I'm never really holding a position for longer than a couple of weeks, versus somebody that might hold an interest in a company for 10 years. And bonds managers are somewhere in between, as are long-short equity guys. There's some equity houses that long-only equity shop that would hold something for 2 or 3 years. It's not uncommon. Some people hold bonds. The question for bonds are whether you hedge them or not. And this is where foreign exchange gets interesting.
I think Horizon is a fascinating question. I think that for an active manager, I know from experience that how long you manage bonds really depends on whether you generate positive alpha or not. So that's actually a hard constraint. But beyond that, we don't really do what Sumit was suggesting, which is to think about alpha or information ratios differently depending on whether it's an alternatives vehicle or a mutual fund or a institutional account. In all cases, we have a consistent definition of what is a statistically significant return advantage over a well-defined benchmark.
Excellent.
And if we can't achieve it, then we don't try to enter the business. So that would be, I think, and that's what clients should look at. The benchmarks differ though. So
you raised an interesting. I'm sorry to interrupt, but I'll forget it if I don't
Please,
interrupt.
please.
Which is, risk parity is one of the programs I run, and to me, risk parity is a smart beta at best, because I'm allocating asset class. It's a tactical asset allocation based on the inherent volatility of each of these asset classes, and the information ratio for that, I have a modeled target of 1. It's trading at 2 right now. Should I say that difference is my smart beta bubbling up, or is it just dumb luck and cyclical? To me, the process is clearly, it's a cyclical story. And I know that information ratio at 2 is going to go to 0 now at some point.
well, if you thought it was 1 and it averages 2 for 3 years and then 0 for the remaining 3, that's okay. But then you've got to consider the fact that you've got more volatility in your alpha as a result of that, from the returns going up and down. And so people should judge you based on how volatile your excess returns are. And if you do it for long enough, they should be able to tell if it's by chance or by design, right? And I think actually I don't want to put too much emphasis on the notion that you should look at historical results only in judging if alpha is repeatable. I think that's an important element of the analysis, but you clearly also need to take into account if the process is consistent with one that would actually have generated that alpha. So in other words, there's no real substitute for extremely thorough proctological due diligence.
Sounds scary. Cristian,
But how do you convince the client that actually your process is going to work well in the different market regimes? So in other words, if the client, for example, supposes something is going to happen in 3 months, how do you convince the client to stick with you for the next 3 years rather than just take out the money because he's scared?
I think I'm going to just try and I guess, both address that as well as the earlier point that was made. To me, the distinction is the liquidity of your liabilities. In other words, what is, as Bob and others pointed out, are you managing money based on overnight liquidity? At what horizon can your clients take money out? Because a lot of the strategies that at least we involve, or that we're involved in as a firm, really involve some degree of illiquidity, if you will, or capturing illiquidity risk premium. And for us, I think the way that we think about creating alpha by and large is really some combination of sourcing or originating sort of non-public situations that others may not be able to access, structuring, creating a risk profile that meets our needs, and in some form risk management, but that's by and large through some form of conventional hedging, but by and large through a very deliberate set of diversification tools. But all of that construct, I mean, this idea of sourcing and origination and structuring and so on and so forth, really works well if you have relatively illiquid funds to manage.
So Sumit, what's the horizon over which you typically would seek to achieve the results you try to achieve?
3 to 5 years, and one of the big assumptions we make is that we are focused on realizations as opposed to revaluations. So we really buy to hold. In that sense, it's a very different approach than any of us in our old days when we're trying to figure out how the market will perceive what we've bought and capture value that way.
I mean, the other way of looking at this is edge. You know, what is your information edge at making the decisions as to how to create your portfolio? And, you know, I think the hot button issue now, as you say, you're spending a lot of time and energy trying to think about the intuition of your process and your edge and and turn that into an algo.
In some senses, yes.
In some ways, to cheapen the cost, fire the expensive analysts and keep IBM.
People like myself.
Yeah, no,
yes.
Absolutely. You're definitely needed until artificial intelligence replaces us all. But the question is that edge, and that information is, I think that's the other part of this puzzle, which is the sum of the alpha may be in the illiquidity or risk premium of the, how long you're holding it and why, and the volatility risk horizons that you're willing to take. And some of it might be in the information that you're accumulating. The set of things that you're looking at now is probably different than you looked at 20 years ago for picking these, merger arb companies.
So I'll make two distinctions. I think the first one is absolutely right, that it's that if you think of the world as being broken up into two forms of strategies. One is liquid strategies like merger arb, for example, and there the edge that we perceive ourselves to having is some combination of just intuition, but also trade structuring, meaning scaling, timing, hedging in some instances. So that's one side of what constitutes edge in our minds, at least. The other bit is on the more private side, where it's a completely different set of factors. It's hopefully all of those things, but it's much more finding the right trade. It's structuring the right trade, and it basically means coming back to our old CDO days and figuring out what the waterfall of payoffs is, and are you getting protected under all scenarios, or do you have excess spread to bail you out, and so on and so forth. And it's also kind of, in that sense, that whole idea of shaping a transaction, which is very different for people like us and sort of our brethren in private debt or private equity than it is to anybody in the public markets.
It's what Sumit said about his private debt process is actually extremely similar to what we do in the public side. So there are these two sides to it. One is being cleverer about nearer term things, and that applies to most liquid markets. But then a huge part of active management in fixed income is avoiding the boo-boos, so to speak. So stay away from things that'll blow up. Well, things that are going to blow up won't necessarily blow up tomorrow. So you will not actually realize that advantage unless you have a longer horizon. And over time, in a sort of over an event horizon, it will manifest itself much as it does in private debt. But because it's hard to have visibility of that process, it's hard to test. For example, as Cristian was pointing out earlier, that he's got tests of various market conditions. How do you test if somebody's actually got a good way to detect whether or not they can pick the right companies to put in a portfolio, whether it's in a private portfolio and a public one? And I think the answer is twofold. One is you see if they've done it successfully for 10, 20 years. But the second one is you see how they're doing it. So if they've got one analyst analyzing 3,000 companies, it's a pretty good bet. They're not likely to be very good at it. So you have a necessary but not sufficient condition that they're devoting the right kinds of resources to the things they claim to be doing.
I think there's, in this process of trying to determine where the alpha is, we did this thought experiment on our phone call, which is in a passive market like equities where ETFs increasingly are taking a larger and larger market share, the process of finding alpha, theoretically, we should just push this and say if the market's 70% passive and 30% active right now, well, what happens if it was 99% passive? Does that mean the 1% that's active are making more? Is there more opportunity for that 1%, or is it less? And I think that's where this liquidity risk premium becomes, and the processes that we're all taking for granted become more complicated.
Arvind, do you have any comments on this? I do.
Where do I even begin? So I wanted to start off by saying that even before you have passive allocations by, say pension funds, you already have a huge part of the fixed income market, public fixed income market, that you would consider passive in a certain sense. Insurance companies, banks, that hold huge parts of their portfolios on a, in a non-mark-to-market sense. And then you've also got, central banks. So they're not non-economic, but they certainly they create segments in the market where the investment horizons are different, and in some sense objectives are different as well. So actually, active alpha means something different to each of those kinds of players, and it is very possible. For example, if there's a huge number of people with liabilities, eventually the market will create the assets to meet those liabilities. But you could go for a very long period of time where, for example, the long end of the corporate bond market could be extremely rich. And within the context of that richness, there'll still be relative value. But when you calculate the returns of that particular segment of the asset class, you might very well find that that group is a non-economic group of investors because they are significantly, persistently, and knowingly underperforming let's say the 5 to 10 year part of the corporate market on a long-term basis, and willing to take those bonds at a much tighter spread than they should, given the negative credit migration that tends to exist at the long end of corporate curves. That's just kind of an example of persistent mispricings.
So I just quickly add to that. So when we try and justify to ourselves again why it is that we charge 2 and 20 for our merger out strategies.
Because you're geniuses.
That small fact aside, I think it turns out that for us, a lot of it is exactly this idea of market segmentation. So the classic situation or the classic argument we always use is when a merger gets announced and you happen to actually be an active or a passive manager or an active manager owning a particular stock that's going to be acquired, it's jumped up in value. Usually it's not jumped up as much as the acquisition price would imply. And at that point in time, you're really faced with the situation of you've had this really lucky windfall, and by and large, your information set or your ability to analyze that company has all but disappeared because it's in play under a different set of circumstances. There's just a process that happens, and there is some likelihood the merger will occur, at which point you will make more money, but there is some likelihood the merger will fall through, at which point you just, will lose all the money you've somewhat inadvertently made. And at that point in time, it kind of very stylizing that example, it seems that what people do is to say, look, I really can't use my traditional tools to make a judgment, so I'll just sell the stock and capture the gains that I've already had. And that sort of segmentation, that nobody basically says, am I going to, that particular person or that investor he or she does not step back and say, what is the likelihood of there's merger going through, and is it being properly priced in the price of that particular stock? In the absence of very many people like that, that sort of that creates opportunity for people like us, who are really focused on understanding the process, understanding what that likelihood is, or at least being able to take a more reasonable view to it. The same thing with distress and so on and so forth. So I think a lot of that is in line with what you were saying.
So what you're saying, you're talking about the irrational investor.
Not really.
Well, or the investor who feels like they have made, this is a lucky break and that they're just going to take their money off the table.
No, it's an investor who's governed by a set of rules that don't necessarily, or
Right.
by a set of rules, or invest by a set of principles that don't necessarily allow them to feel comfortable.
Yeah, Bob, I think that this is a segmentation issue, because actually the investor that's getting out is doing something totally rational
For their process.
for their process.
Right.
And I think actually that, I'll give you a totally different example along exactly similar lines. Why is there so much vol skew in the markets? In other words, out of the money vol is priced much more attractively than at the money vol. And a huge part of that is the regulatory pressures on institutions that would normally have arbitraged that away, who now have to actually instead go out and buy protection or anything that they're long, because their stress tests would fail otherwise. So this means that there's another group in the market that can take advantage of that. And that's true in FX, it's true in rates.
But that's the 99%, 1% problem, right? Because at some point in time, this skew actually works against the short-term. A market that has an infinite skew, as I guess the VIX would, or some of the fixed income market, it's much harder to trade. And it changes the underlying nature of the present market. So the feedback loop of all this regulation has some implications. And in foreign exchange, the players that are irrational.
In what sense do you mean that it's harder to trade?
Well, because when vol skew is steeply priced, your implication is that the present vol is should be going up, but if it doesn't actualize to tomorrow's higher price, you're going to continue to sell. And your market is never going to live up to the expected steepness of that curve.
Yeah, that's all true in a time sense. I'm also just saying that vol is mispriced in both the short end and the long end.
Yeah, and then there's arbitrage potential, but nobody can do it. I think that the point that I think confusing alpha with players that are doing it for non-alpha generating purposes. In foreign exchange, central banks intervene in the market because they know that the currency market is a monetary policy tool, and they don't care if you make money from their intervention.
Yeah.
Right? And corporations hedge positions in foreign exchange not because they care that the currency might be going up or down, but to repatriate for tax reasons. Wait until we have a repatriation tax plan, and see what happens. Corporations will bring their money back, and they won't care what the rate is on the dollar, that they're getting back. So there are non-economic drivers to lots of markets, but I'm not sure that that's alpha.
Okay. Well, we could argue about what it's called, but you make money, and
how you get allocated, investment from that is that's really the problem, right? The transparency problem.
I mean, I'm saying in a way that these functions that certain parts of the market are playing are useful, and whether you choose to call them alpha or some sort of risk premium is in a way beside the point, because the market's going to decide the pricing of that service. So to give an example from FX, right? You mentioned two sources of market segmentation. A third one arises in all emerging markets because everybody who goes in and invests in EM doesn't also want the currency risk. A lot of the time, those currency risks are positively correlated with the assets they're buying, so they need to either partially or totally hedge that. Well, that service is not going to be free because there are not as many people on the other side of that trade who wants to just be long the currency, which by itself shouldn't have, economic value. So they're going to have to pay, on average, some type of risk premium to hedge that. The person providing that service is not necessarily providing alpha.
No, but I charge for it.
There you go. Exactly.
No, I get your point. It's a fair point.
So, Cristian, you had some comments you wanted to make about measurement.
Well, so for me, it's like that saying. It doesn't matter what the color is, the cat, as long as it catches mice. So for me, the most important part is the actual performance of the strategy, and also whether it is robust and whether it is persistent. And that's the part for me I have some problems with some strategies, because I don't have enough information to make that judgment. So if you can comment on that.
Will you ever get enough information, though? I mean, the problem I have with that response is that markets change. So the foreign exchange market that I grew up in is no longer in existence. The market went from open outcry to electronic to now, 75% of everything's done is electronically.
But I'm not talking about the type of market. So imagine, for example, that you are going to base everything that you have as of you are in 2008, and you are going to base everything that you have, your strategies, as of 2007. And suddenly the market changes completely, the correlations change, the dependencies change. So I'm not clear how you are going to deal with that.
Right, and does backtesting,
No,
and this gets to you,
doesn't work.
or stress testing provide you so do you want a Monte Carlo, do you want a historic reference, or do you want to do...
Well, that's the challenging part, because neither of them are working well, since, for example, one of the main challenges is the following, that you are going to, let's say, have some stress factors, but you don't know how the other factors are going to react. So you are going to, let's say, change only 3 of them, but then the other 27 are not going to change in the same way as they changed before. So
Isn't that then become basically a resounding sort of vote in favor of active management, in the following sense that one would assume that with, I guess, experience, intuition, age, you then you can't really either backtest, and you can't just basically say anything can and might happen, therefore I won't invest. So then isn't really the trick really boiled down to figuring out some sets of scenarios and the correlation surfaces amongst different parameters, including liquidity, which, by the way, we usually try and sort of always kind of shy away from, both in terms of whether you can buy or sell, or whether you can finance securities, which some of us who were in fixed income arbitrage in 98 and 2008 sort of got caught on the wrong foot on. But isn't that then become sort of a resounding argument in favor of active management?
not necessarily, because again, it's unless you are going to be able to test that relatively well, it's more like trust somebody.
But I mean, the reduction to the absurd is that no one's going to be able to live up to the standard.
But, yeah, I mean, from that perspective, this is a very nice theoretical argument, but in practical terms, you actually have to see some results to convince you.
I think the answer could be different for different types of risks. So for top-down macro risks, there are relatively few of them, and then there will be some that the right alignment will save you in the next crisis, being long interest rates, being short interest rates, being short credit, whatever it is, right? Being long certain kinds of equities might save you in the next crisis. But you might not be able to demonstrably prove that, in which case let the market decide if it wants to pay for that service. But when it comes to bottom-up stuff, I don't think you could argue that the entire market could be passive because you can't tell one credit from another, because after all, someone's got to buy the stocks.
If I'm the client, so it doesn't matter to me what the sort of everybody else is doing. I actually want my money to be managed well. So how can for me the problem is that I'm not sure exactly how the client can be convinced that a particular strategy is going to work well in the near future, without actually having some quantitative metrics to do that.
It seems to me all the clients that you might be talking to are part of the problem, because at some point in time, if you don't want to pay for active discretionary management, you will get passive, non-thinking management, and you get what you pay for. So,
But I'm saying you can pay for
and
active.
clients are being penny wise and pound foolish.
Right, but you can pay for active for some people that are very good at that, and you can pay for active for some people who may not be that good. So how can you make a
That's
distinction?
totally true, Cristian. And actually, I'd say, that there's a lot of truth behind the move to passive, because there's been a lot of active managers that have failed to deliver on their promises. But what I'm saying is that the logical conclusion of that is not viable either. In other words, that the whole world goes passive.
No,
Clearly, you need the
I'm not
active
arguing with
management.
that.
So from that standpoint, there's somebody out there that's making money from active management, and there's somebody that actually decides the price of these things, because everyone can't just buy the index.
So can I sorry,
Yes.
I'm afraid we need to cut this short.
Yeah, good.
Because,
We're holding people off from drinking.
yes. And questions. So questions?
Question for all the three panelists. Does this systematic passive money create any systematic macro risk to the world? The amount of money which has gone into these products in a very relatively short period of time. Do you think like 4 or 5 largest companies own 80% of ETF? Do you think it can create a macroeconomic systematic risk?
Yes.
Yes.
That is sounding yes.
There isn't enough liquidity in the world. It's very easy to get in, and it's very hard to get out all at once. So there is a liquidity mirage in a lot of the passive money flows, and ETFs are an example of that. But I don't want to be a Cassandra. I don't want to tell you that the sky is falling at any given moment, and I don't know the nature of the next crisis. It's going to be different than the last crisis.
Having said that, I mean, I'm not aware of a situation created by passive that is similar to, let's say, leverage. I think they're fundamentally different kinds of risks in the market. In other words, where leverage created the possibility of entirely bringing down the financial system, I think a certain percentage moving from active to passive simply exaggerates the volatility associated with fundamental effects. The market will still clear. It just may clear at a much different level than before.
Yes, I agree with Arvind. But then on the other hand, you had this issue in August 2015 where the ETF market behaved very strangely for one day. So it may happen.
Thank you very much for the great topics. The question is, we've experienced quite extraordinary market environment over the last 8 years, and obviously, the excess liquidity provided by central banks across the board influence the outcomes of passive versus active. Going forward, knowing that we already got some signals that central banks intend to withdraw some of that liquidity. How do you think the passive versus active will look in the other side of the cycle?
I mean, we're all sitting here hoping that something changes. I think that increased volatility is one of the expectations, but I dare you to buy vol on a very steep curve. I think 2018 volatility for the VIX is somewhere around 24%. So, and it's actualizing at 5. So, what do you do about it? How do you hedge this risk? I'm not sure that the passive versus active debate wrapped around the inversion of the capital waterfall is really the larger problem. And I would say the problem is people buy bonds for capital appreciation, not for the coupon, and people buy stocks for the dividends, for the cash flow. I mean, that's been the lesson of the last 8 years. So the world's been turned upside down.
I was going to say, I'm not entirely sure whether central banks are really responsible for the drop in vol, although
Really?
it's widely.
They killed the market. If you own 50% of JGBs and the ETF, I dare you to trade.
You may very well be right, Paul. I'm just saying I'm not sure. I think there are lots of other reasons why vol has gone down as well. But long-term vol may go up regardless, and if it does,
Might be
actually
cheaper
I think
24.
there'll be more active, there'll be more opportunities to generate active returns, I think.
So I'll make a very stupid comment, which is that in my very simplistic view of the world, it seems that the last few years has led to asset price inflation. It's led to a dampening of volatility, a few temper tantrums here, a few crises here and there. But if you just think about Draghi's famous comment about the euro and how markets completely subsided, you've just had a lowering of dispersion and volatility. So ex ante that if central banks are gaining liquidity, then all of these effects should reverse themselves. That's number one. Number two is that the era of low rates and overall low returns has basically meant a lot of folks trying to gloss over in some ways, because the active manager's contributions has oftentimes been notable but not sort of significant compared to the fees that they've asked for. Right? In a world where there's a lot more volatility and therefore hopefully more returns generated from active management, then I think a lot of that passive active debate will naturally resolve itself. Sure. One more question? Great. Thank you, everybody.
All right, thanks.